And also, this question was like, is this about race? Yes, it seems very much to be about race, because like the current financial situation of households is something that's still inherited from 150 years ago. And now, I think regarding your question, it's like this, and the point that also Illenin made about asset market participation. I think this is a dimension that overall we still have room to study and to understand better. Why do some people not invest in certain asset classes? Okay, and then one thing that obviously comes to mind is discrimination, both in the housing market but also in the credit market. And I think that's not like, I think I'm going to repeat the last point from my conclusion slide. It's not directly obvious to me that the measures, the instruments that the Fed has to its disposal are like the best targeted instruments to address these problems. Okay, but I think obviously investment, and also I think there we maybe also have to think about things like trust in the financial systems, also some weaker factors that might play a very important role here.
I wish that sort of in this paper, the authors explicitly look on these disparities. I think the unemployment rate one is exactly one, but I think they could have gone further. And I think the example I gave with sort of the housing sale return is an example where one sees and knows that those margins matter. There have been papers on the refinancing rates and others. But I think if one wants to do this sort of calculus on sort of how the portfolio is changing, both on the intensive and extensive margin, one can sort of use more micro data and explicitly track the actual experiences over time of this household, of the households of different wealth levels and of different racial groups. And to sort of really sharpen the difference between just wealth, I would say, and race. I think perhaps the harder and more important questions for us all might be, where do these disparities really come from, and how do they vary over the business cycle? And how do these, in fact, in turn, interact with the goals of monetary policy?
There's a lot of interest in large-scale heterogeneous agent DSGE models. So I think the key thing about these models is that you should have Gini coefficients that are not zero, that approach the U.S. data. And a key question for a policymaker like me is, what's the role of monetary policy in such a model? And the answer in this paper is going to be, if the other policymakers are pursuing a good policy, then the role of monetary policy would be unchanged. Classic combination of policies can deliver a first best allocation of resources in this highly stylized environment where you do have substantial inequality in income, wealth, and consumption. A monetary policymaker would have to provide period by period insurance against the aggregate shocks. That's why the monetary policymaker would be adjusting all the time. Then you could have non-distortionary labor income taxes. You could have an unemployment insurance program. And the education policy can also drive the consumption Gini all the way towards zero or towards some minimum value that you think is out there. But that would leave income and wealth Ginis at positive levels. So again, we're not saying this is actually going on in any of the OECD economies, but we think these benchmarks might be useful for understanding which policies we could alter, what features that we think are keeping us away from better outcomes for the macro economy. But you could use this benchmark economy and perturb it in interesting ways going forward.
So there's some things that I really like about this research agenda, and I think is really to be commended. So the first is I really love the focus on exploring mechanisms for non-neutrality, why the central bank through its standard types of policies can influence welfare and real outcomes more generally than that, is beyond sticky prices. So this non-state contingent nominal contracting friction, I think, is really key. If I personally had to think about what's the most direct way in which I'm influenced, my outcomes in my life are influenced by inflation, it's the fact that I have I have a mortgage, which is a really big non-state contingent nominal contract, and that's beyond sticky prices. That's probably the most direct effect of inflation on my own welfare. So that kind of feels really important, and there hasn't been enough work like that done in the macro literature. The second thing that's really to be commended is to focus on the redistributive aspects of monetary policy rather than the aggregate stabilization. That's a direction that is for another discussion, but I think I think everyone here understands that that's an area in which monetary policy has moved, and building models that can help us understand that is really to be commended.
So the main message of the table is that Black households face about 16% higher price volatility than white households. And you see this in the standard deviation of their consumer price index, which is a price of their consumption bundle. Depending on whatever these households buy, the prices may vary more often or less often. It ends up being that the prices for Black households vary actually more often. And you see this also in this frequency of price changes. No matter how you measure it, the frequency of price changes, the percent of it changes that fluctuates every month is higher for Black households. So overall, I think we have sort of the basic ingredients to start thinking about this trade-off. First, Black unemployment about twice as much as white unemployment at all times. However, very close co-movement over the business cycle. Second, the volatility of Black inflation is about 16% higher than the volatility of white inflation. This matters because it means that Black households have both more to gain from reducing unemployment, but also more to lose from increasing inflation. To evaluate this trade-off, we're going to set up a model and evaluate it in a calibration, which is what I'm going to show you next. What we are trying to do is understand how an accommodative monetary policy, one that has higher values for C, will affect the unemployment rate and the prices, and in particular, given that we have these two effects, the unemployment effect and the prices effect, how these two things are going to play out into the net effect on income volatility for Black households. To make this a teeny bit more realistic, we're going to add rental income so that we can think about the great disparities in home ownership between Black and white households. This also implies that we're going to have a slightly different price index, which you see right here. And this is all I had to say. What have I shown you today? I've shown you two things I think that are relevant to this debate. One is the interest rate rule that targets Black unemployment really is equivalent to one that places more weight on aggregate unemployment. And two, such an accommodative monetary policy can actually end up increasing real income volatility for Black households if inflation expectations become an anchor. And this is because the prices effect dominates.